Good afternoon, everyone. I will start with, you can see here the agenda. Obviously Rob is not with us, so I will read what Rob said at the actual announcement. I have it in front of me, and then obviously we'll go into my results summary, a bit of an operational review, and then I'll hand over to Chris Hunter, who's with me today, who's head of finance, and he will look at the numbers and run you through those slides. I will then run you through a slide on outlook and guidance, and just run you then through what are my immediate priorities whilst in role. So moving on to Rob's. This is the slide that Rob presented, and I shall read from his script so that I don't change any words that he said at all. Rob said, "It's been a disappointing year for the group. Performance has fallen far short of expectations. When we became a pure play software company, we did so with market leading high technology product, which was perfectly placed to address a significant and growing market, being driven by both regulatory tailwinds and a growing awareness of the need for data sanitisation. That has not changed. While I do not doubt that the corporate actions we have undertaken in the last year, acquisitions, divestments, buying out minorities, have substantial strategic merit, it nevertheless put significant strain on Blancco's financial position. When combined with non-payment of receivables, it resulted in the difficult situation in which we found ourselves over the summer. In September, we announced the reversal of 2 contracts booked as revenue during June 2017, following a number of matters being brought to the board's attention. Following this, the board undertook a review of the circumstances surrounding these contracts, and further work was performed to assess revenues in the year to the 30th of June 2017. This work identified other adjustments to revenue for the year ended the 30th of June 17, where some contracted revenues had been deferred into future periods in line with the expected contract fulfilment, and a prior year adjustment. In respect to the latter, the results for the prior year 30th of June 2016, as well as the corresponding balance sheet position, have been restated. We will go into more detail on this shortly. I'm here today to tell you that the board takes this very seriously, and we are 100% focused on driving the company forward and delivering sustainable growth. We are making positive steps forward, which Simon will go into in more detail on his slides. These steps are to make sure that we operate in the company in a focused way, and that we ensure that we have the most robust controls and processes in place to support our operations. But let us not forget that this is a business with real strengths. We have a sophisticated product which we will continue to invest in. We have excellent people, and we have a leading position in a nascent market that will grow strongly in the coming years. There is no doubt in my mind that we need to rebuild trust in the company. This is a challenge that we are embracing. Simon and his team alongside the board are working hard to stabilise the business, and there is a process in place to recruit a new CEO. We will not rush this, but when they do come on board, I believe they will find a company that has all the ingredients to thrive and generate long-term sustainable value for the shareholders. We look forward to taking your questions after the presentation, although there are a number of topics following the internal work that I've described which we are not able to comment on for legal reasons. So now I'll pass over to Simon. Hi, I'm Simon. Pleased to meet you. Next slide, here we go. So I'm going to run through a summary of the financials, and then I'll hand over to Chris to put more detail on the bones. The first message obviously is that we restated the 2016 results. This was the reversal of the original transaction that we originally provisioned in FY17 numbers, and we announced that on the 6th of July. The impact in 2016 is to reduce the revenue and profit, which we'll talk about more on in the next slide, and remove the provisioning that we had made in 2017 for that contract. After the corrections, revenue was up 31% to £27.7 million, or 17% growth in constant currency. Adjusted operating profit was £3.4 million compared to the restated number of £4.6 million in FY16. Profitability was impacted by cost increases, principally as a result of recruitment and increased marketing spend. Chris will talk in more detail about the results and the cash flow later. Having considered this result and the need to maintain investment in the business, the board has decided not to pay a final dividend. So, moving swiftly on to talk about the prior adjustment. Fundamentally, a view of the circumstances around this transaction at the time it was booked have now shown that there was not a contract in place that met conditions for revenue recognition at the time. So we have made this prior adjustment. The impact of removing this transaction on the previous announced 16 results is to reduce revenue by 1.2 million and to reduce the AOP by 1.5 million down to 4.6 million. Obviously the restated revenue is 21.2 million. And in the balance sheet, 2.1 million of receivables and 0.6 million of deferred revenue have been removed. Operations. Quick summary and run through of this. The market for data erasure and diagnostic products remains strong. That's the first and very important comment to make. The focus within the company seems to have moved towards mobile and has seen strong growth in diagnostics and mobile erasure, which we'll see on the next slide. The business continued to invest in product development, and from an M&A perspective, the business bought in the minority stakes in France, Canada and Australia. It bought in 20% in Mexico and in APAC. And it sold off the DigiCare business, which impacted cash flow, as you can see in Chris's numbers. Product performance. As I said, we had a strong performance in mobile erasure and diagnostics market, following the winning of a number of contracts and the rollout of our product in a large US mobile operator and retailer. Active erasure and professional services reduced because of a couple of large one-off non-recurring deals during 2016. End-of-life erasure marginally declined in constant currency and probably suffered due to the focus on enterprise and mobile. And product development, as I said earlier, we've continued to invest in product development and remain ahead in our product, and we keep our market leading position of product. The focus has been on integrating and enhancing our existing product range to provide our customers with the best solutions available. You can obviously read this slide at your leisure. In terms of geographical performance, as we can see here, Americas, which includes the US, LATAM and Canada, has declined in constant currency due to £1.5 million of non-repeat one-off revenues in LATAM during 2016. Excluding this, the US and Canada alone grew by 47% in constant currency. Europe's new leadership have grown the business by 13%, while Asia and the rest of the world grew 12%, primarily driven by our JV in Japan. Alan Bentley, who headed up our Europe's resurgence, has taken over the role of VP of Global Sales, so is now looking after the whole of the world. And so now I will hand over to Chris to run you through the more detailed numbers.
Thank you, Simon. The group has seen strong revenue growth in the period, and as Simon mentioned, we recorded an adjusted operating profit of 3.4 million. This is slightly lower than the restated previous year figures, and we've also seen a currency benefit on the top line. The annualisation of the US mobile carrier contract has contributed to the growth in the top line performance, as we've worked closely with the customer to roll out our solution across their 6,000 stores, and we're now seeing diagnostics events of over 100,000 per week. The diagnostics business has grown from 1.8 million of revenue in the first half to 2.5 million in the second half, which reflects a number of smaller deals to similar carriers in the rest of the world. The diagnostics and mobile products have also shown good growth in the Asia market, contributing to this. The Eurasia has been more modest in terms of growth in this year, with the impact of the performance in LATAM reducing the growth compared to the diagnostics segment. However, the investments we've made in the US and Europe have resulted in a constant currency growth in the region of 20 to 30%. Overall, the high investment has increased the SG&A costs by 58% or 35% in constant currency terms. The focus in FY18 will be on making sure that the cost base is well directed to position the company for growth. Moving on to the next slide shows the impact of currency and the weakening of the sterling following the Brexit vote in June of 2016. The group's revenues denominated in sterling only comprise around 10% of the total, and this results in around a 3 million favourable variance at the revenue line. At the profit line, the impact is much less severe since our costs and revenues are relatively well matched across the group, and there's only a 0.2% impact at this level. When the impact of the annualisation of the US mobile carrier is taken out, the constant currency growth for the business was 6%. The next slide shows a bit more detail around the factors that drive the revenue progression year on year. We've split out the underlying revenue from revenue arising from what we've called non-repeating volume deals. These generally represent contracts which are one-off in nature, not expecting to recur in future periods, and customisation or project work. As you can see, the underlying revenue is a little lower than the reported revenue at 20% in constant currency terms. Net of the non-repeating business and including the US mobile contract, the growth is 25% in constant currency terms. In terms of the regions, the lowest performing region is the Americas, which has gone backwards slightly due to the impact of the LATAM business. A number of the deals won in the US and the Canada business have added to our subscription revenue stream, which will be recognised in future periods. And you can see at the bottom our subscription revenues have grown significantly, now representing 28% of revenues. The next slide shows the impact of our investment and M&A activity in the year on the cash flow, and there's been an underlying reduction in cash, which has been offset by the share placing which took place in the year. The cash flow conversion percentage for the year has been 80%, which is our adjusted operating cash flow, expressed as a percentage of adjusted operating profit. The 2.8 million that we've generated has gone wholly on the CapEx in the year, which is predominantly our R&D investment. After interest and tax and dividends, we've seen a net cash outflow of 3.1 million. The M&A activity for the year has covered earn-outs and the disposal of the digital care business, which has seen us move to a pure play software business, and also taking out increased stakes in many of our sales offices, which has given us better control over the operations in those locations. Restructuring in the year is a cash outflow of 1.7 million, and this largely covers the restructuring in the year, a patent case from the first half, and some fees associated with the closure of one of our offices in Germany. The total R&D capitalised cost has increased from 1.8 million to 2.6 million. The increase is largely driven by currency and also the acquisition of the R&D team in the Excalibur transaction. The cash cost has increased year on year by around 33% and represents around 13% of our revenues. The balance sheet position for the business is largely unchanged from the previous year. Our deferred revenue is up 40% year on year, which shows our move towards our subscription income stream. Of the total balance, 4.5 million of this will be recognised as revenue in 2018. The balance sheet shows here net current liabilities of 9 million. However, when the cash in the group of 11.6 million is added back, we're in a positive net asset position. Additionally, there's a number of provisions in the liabilities section for which there isn't expected to be an immediate cash outflow. And I'll hand back to Simon to talk us through the outlook and guidance for the next year.
As you can see on this slide, this is the top part of this slide is a repeat of that slide that Chris presented to you, I think on slide 13. And you can see we've split out what we call non-repeating volume deals here. We've split out the US mobile contract. So you can see what we call underlying revenue, FY17 versus FY16. The non-repeating volume deals are one-off big volume deals which fall in the year. If they come through, then great news. If they don't, then we've got the underlying revenue. What we've done here is also show the US mobile contract, and you can see the impact of the annualisation of that contract. So underlying revenue growth, 17 on 16, was 12% in constant currency. If you then look at the bottom of the slide, we've now included the US mobile contract within underlying revenue, within the 26.7 million, on the basis that that will roll forward as underlying. And our guidance is based off that 26.7 million. So we would guide that our underlying revenue growth would grow between 10 and 20% in the year. The AOP margin on that would be between 8 and 12%, dependent obviously on the growth rate in revenue. Now that is impacted by the annualisation of the cost base that Chris was talking about earlier, with a little bit of inflation and a little bit of cost savings. We've not forecast any non-repeating volume deals. If those come through, then great news, and obviously we will let you know during the year if those do come through. So what are my immediate priorities? Well, I think we need to keep the business focused on maintaining and winning new business. We need to invest in the product, and we need to enhance the financial controls while maintaining a very strong focus on the cash flow and cost management. The leadership team will work closely with the regional teams to support them and enable them to grow the business. They are key to the growth in this business. I don't anticipate any material alterations to the business activity or changes in direction, so that a new CEO, when they come on board, will be able to transition into the business and formulate their own strategy, drawing on the experience of the existing Blancco team, and move the business forward. So thank you very much for listening, and we will now take any questions.
Thank you, gentlemen. And a quick reminder, you can submit your questions via the icon on the top right. We have a number already, so let's get cracking. Sam, probably one for you. Could you elaborate a little bit further about what the board is looking for in a new CEO in terms of qualities, experience, skill sets? And is it fair to assume that they would be based in America, as Pat was?
They are looking internationally, so they're not just limiting it to the US. I think a key skill set and a key experience for this person will be somebody from the software industry. I'm not from the software industry at all, so my view of this is I'm basically applying common sense business decisions to what we're doing and how we're moving forward. I think that's going to be key. Obviously somebody that's successful, and obviously somebody that the board believes can guide this business going forward. I get the impression that the people that have been so far in the process, there are a number of people that the board believes are more than competent to run this business and take it forward, so they feel confident, and I think the process is advancing.
Thank you. Now a question on the EU data protection regulation. Could you opine whether more opportunities will arise from this for you in the area of erasure or diagnostics, and also how long do you think that new interest would be represented in actual contracts being signed?
The short answer is I really don't know, to be honest. You would hope so, and you would expect so. I think there's an interesting thing happening with data. I've seen and come across in the last 3 years a number of companies where they've had data breaches, and the perceived antidote to that is to build a bigger wall. So they're spending a lot of money on this cybersecurity. The issue is that as the amount of data grows, the cost of protecting it becomes ever larger. So at some point, and I've seen it in one company where the CIOs turned around and said, hold on a minute, do we need all this data? And that's where the data erasure piece will start to come in, we hope. How that evolves, how that develops, I don't know. EU GDPR is potentially provocation towards that, particularly if somebody starts being fined big numbers. So we hope it has an impact. How quickly that will happen, again, I don't know. Will it happen? Again, your gut says yes, but the real answer is I don't know. We've just got to stick to our knitting and make sure that we're a bit like a coiled spring. So when that kind of opportunity does arise and people start knocking on the door, we need to be capable of providing the solution. Active erasure, that active erasure product that we have, is particularly interesting because it does allow you to erase data in a working environment without shutting down the systems, and it will hunt through within data center, within the cloud, within your network to find those files and erase them. And that's something that I believe is quite unique to one of the product sets that we have.
Thank you. And just to draw on your gut again, I'm afraid, Simon, how do you think the European regulations will stimulate compliance outside of Europe? Is it seen as a watermark that America will aspire to?
Hey, look, again, I've no idea whatsoever, but I think it's the route that countries and nations are taking. I mean, Mexico has particularly stringent regulations already. I just think the route is to more security around it and less data and more control over data. So if that's where it is headed, then that's good for us.
Thank you. Right, we have a shareholder who is very pleased by what he's read in terms of your recent statement and what he describes as a return to focused management. clearly you will have been seeing some of your larger shareholders since the results were released. Can you just update us generally as to whether they are also buying into that positive message?
I hope and I believe that they are buying into a more humble approach to presenting our numbers, a more transparent set of numbers here, and I think less ambitious guidance, and so I think those three elements are coming to the fore. Unfortunately, as I said, my background isn't software, so I can't answer a lot of technical questions. I'm relatively content free, to be frank. These guys in the business, we've been doing an awful lot of work to get these results solid, and I think there's a sense of relief now that people feel these are a set of solid numbers, they understand what's in them, and we can move forward from here. So I think that's really the messages that we've seen.
Okay, and following on from that and moving forward, do you sense that your visibility with clients or market share has suffered during this period of distractions? Or is it just simply a case that in a growing market, perhaps one or two opportunities may have been missed, but you still have considerable momentum in the area that you're active?
The blunt answer is I really don't know. I think we've seen growth in mobile. I mean, Chris may have more of a view because he saw the whole year out. I came in after Easter. But I get the impression that there's been certainly a good focus on the mobile business and the mobile industry, and that has allowed us to grow this last year. And as a sales organisation, if you're pushing on an open door, it's obviously easier to open those doors. We are quite a technical sell, it's quite a technical piece of software. Have opportunities gone missing? I don't really know. I don't really think so. Have we been as efficient as we might have been? I'm sure we can always improve, but I don't know, Chris, what do you think?
Yeah, I think that's fair. I think the business has put a lot of priorities out towards the start of the year and over the course of the first half of the year. And there's been a lot of focus on many different areas, growing certain new areas, new locations, new sales channels and new products as well. I think on an underlying basis, we've kind of shown that we've had some success in following some of those, but perhaps some of those are on a longer sales cycle and taking a bit longer to ramp up, along with all of the new heads that have come in. So I think the business needs to consolidate where it's got to in terms of its heads and priorities, but I think we're well placed for what's to come in FY18.
Good, and linking that to another question about the broader marketplace, presumably the mobile area has come as a pleasant surprise in terms of the demand for erasure at the moment.
Yeah, I think we always knew that the mobile market was growing, and certainly in erasure. And you have a situation where it continues to grow. The recycling of mobile phones is increasing. The numbers that are being recycled is increasing. There's also the retail element to this. So the ability to have a piece of kit in store that can diagnose what the phone has done, where it's been, all the diagnostics around what's the software on the phone, battery usage, etc., so that the retailer can tell effectively what the phone's worth and where it's been, what its track record is. The other point is the transfer of the data from that phone onto a new phone if you're upgrading, and the ability to erase the data on the old phone in store. Those are quite key to the retailer because that allows the phone transaction, the retail transaction, to be more seamless. and also to be able to send a phone back to their warehouse that has already had a diagnostics done on it. So it cuts out a lot of the processing behind the scenes. So that's been quite a bit of a breakthrough. We hope that will allow us to offer that kind of solution to other mobile operators, and we're in discussion with a number of them. So that's been a good win, if you like. But as Chris said, it's about keeping our priorities quite tight.
Graham, perhaps a final question here. One holder has read a report from a broker commentator who is forecasting diminishing margins in mobile erasure that will lead to negative cash flow next year. He presumes that you would disagree, but could you elaborate why you would have a different view in a little more detail?
Hey, look, if I had a crystal ball, then I'd use it. The reality is that we're seeing an opportunity in terms of volume and growth. So we're not seeing a massive erosion in margin. There will be competition. There's bound to be. You only get a free run at a market for a short period of time. And does competition help or hinder? Well, obviously it has a pricing impact, but actually there's a huge market out there, much bigger than we are, and therefore there's a big opportunity to go after. We're way ahead of the game in terms of size, and therefore we need to make sure that Blancco Technology Group stays ahead, and that's where we are really.